What if the biggest financial shift of our time is happening right under our noses? While many of us are glued to the stock market, the world's largest corporations are in a quiet race to do something radical: swap their cash for Bitcoin. This isn't just a quirky trend, it's a multi-trillion-dollar pivot that's setting the stage for a supply crisis so intense it could push Bitcoin to an incredible $3 million. Let's be real, the global economy is feeling a bit wobbly. Governments are printing money like there's no tomorrow, inflation is eating away at our savings, and the traditional financial system is showing its age. For a long time, the only safe bet seemed to be gold or the US dollar. But a new playbook is being written, not by governments, but in corporate boardrooms. They believe they've found the ultimate hedge against uncertainty: Bitcoin. This isn't about a couple of tech companies playing with crypto anymore. We're talking about a calculated, strategic move by mainstream corporations managing billions, even trillions, of dollars. They are quietly turning their cash reserves into a decentralized digital asset. So what happens when the most powerful economic engines on the planet all try to buy the same, strictly limited asset? You get a supply shock of historic proportions. Today, we're going to look at this corporate revolution, from the pioneers who kicked it off to the giants now joining the race, and break down the mechanics that could pave the way for a multi-million-dollar Bitcoin. This is the story of how corporate America's hunt for stability might just trigger the most explosive price rally Bitcoin has ever seen. Section 1. The Corporate Treasury Revolution. The first tremor of this earthquake came from one man and one company. Back in 2020, Michael Saylor and his firm, then known as MicroStrategy, did something that seemed utterly reckless. They started converting their company's cash reserves into Bitcoin. The financial world was floored. But Saylor's logic was simple: cash was a liability, an asset guaranteed to lose value over time. He famously called it a melting ice cube. Bitcoin, on the other hand, was a hard asset with a fixed supply that couldn't be devalued. And he didn't just dip a toe in, he went all in. The company, now fittingly rebranded as Strategy Incorporated, has essentially become a Bitcoin acquisition machine. As of late 2025, Strategy Incorporated holds a jaw-dropping 640,808 BTC. That's over 3% of all the Bitcoin that will ever exist, all held by one public company. For years, people watched from the sidelines, calling them an outlier. But other companies weren't just watching, they were learning. The logic was hard to argue with. Why hold an asset that melts when you can hold one that appreciates? Now, it looks like the floodgates are opening. Publicly traded companies now hold over 1 million Bitcoin on their balance sheets, and the number keeps growing. We're seeing Bitcoin miners like Mara Holdings with over 52,000 BTC and Riot Platforms with over 19,000 BTC holding onto the coin they produce as a treasury asset. And it's going global, with Japanese firms like Metaplanet making Bitcoin their main reserve asset, now holding over 30,000 BTC after being inspired by Saylor's playbook. This trend got a huge boost from a key change in accounting rules. The Financial Accounting Standards Board, or FASB, now lets companies report their Bitcoin holdings at fair market value. This might sound dry, but it's a game changer. Before, companies had to write down Bitcoin's value if the price dropped but couldn't write it back up unless they sold. It made holding Bitcoin look terrible on a balance sheet. Now, with fair value accounting, the true value shows up, removing a massive headache for any CFO. What started as one company's wild bet is fast becoming a standard playbook for treasury management. These companies aren't just speculating, they are buying for the long haul, locking coins away in corporate vaults. This is where the supply squeeze begins. Section 2. The Floodgates Open, the ETF Effect. If corporate treasuries were the spark, the arrival of spot Bitcoin ETFs was pure gasoline. For years, the only way for big money, pension funds, endowments, traditional asset managers, to get exposure to Bitcoin was to buy it directly, a regulatory nightmare for most. Then, in January 2024, the SEC approved the first spot Bitcoin ETFs, and everything changed. Suddenly, buying Bitcoin became as easy as buying a stock. The institution that led the charge was none other than BlackRock, the world's largest asset manager, overseeing more than $12 trillion. BlackRock's iShares Bitcoin Trust, IBIT, wasn't just another fund, it was a stamp of approval from the heart of Wall Street. The inflows have been stunning. Since its launch, IBIT has become a black hole for Bitcoin, and its success has driven the entire narrative of institutional adoption. The scale is immense. As of late 2025, spot Bitcoin ETFs collectively hold over 1.1 million BTC. BlackRock's IBIT alone has become the dominant force, holding approximately 805,000 of those coins. This matters because it unlocks a tidal wave of new capital. Pension funds, which manage the retirement savings for hundreds of millions of people, are naturally conservative. They need regulated, familiar investment products, and the ETF is exactly that. We're now seeing major institutions start to dip their toes in, allocating a small slice of their portfolios to Bitcoin through these ETFs. Cathie Wood of ARK Invest, a longtime Bitcoin bull, bases her price predictions on this, suggesting that if institutional portfolios allocate just around 6.5% to Bitcoin by 2030, the price could see an astronomical rise. Think of the ETFs as a relentless, automated buying machine. Every day, as more money flows into funds like IBIT, the managers have to go buy more Bitcoin to back the shares. They aren't trying to time the market, they are price-agnostic buyers driven purely by investor demand. This creates constant, structural buying pressure, soaking up available supply day after day. Section 3. Building the Foundation, Political and Regulatory Tailwinds. For a decade, the elephant in the room for Bitcoin was regulation. The fear that governments could just ban it paralyzed big, conservative institutions. No board of directors was going to put billions into an asset that could be outlawed with the stroke of a pen. But that story has completely flipped. In the US, the government's stance has shifted from hostile to increasingly friendly, and that has been pivotal. We've seen pro-crypto legislation, like the Genius Act, signed into law in July 2025 to create a federal framework for stablecoins. This signals a clear intent to nurture innovation, not crush it. On top of that, the Trump administration established a strategic Bitcoin reserve in March 2025, ordering that Bitcoin seized by the government be held as a national asset rather than sold. This sent a powerful message. Bitcoin is now being treated as a strategic asset at a national level. That kind of signal gives the institutional world the green light they've been waiting for. This regulatory clarity is a massive de-risking event. It tells every corporate treasurer and pension fund manager that investing in Bitcoin is no longer a fringe, career-risking move. In fact, the risk is quickly becoming not having an allocation to it. This is the kind of shift that can trigger an S-curve of adoption, a slow start with early adopters, then an explosion of mainstream growth. Corporate and institutional adoption of Bitcoin is just now hitting the vertical part of that curve. The regulatory green light is the catalyst. Financial giants are moving in. We're seeing major banks like Goldman Sachs and DBS get into crypto derivatives, building the kind of mature market infrastructure needed for even the largest players to participate safely. The government isn't fighting Bitcoin anymore, it's building the guardrails to integrate it into the global financial system. Section 4. Beyond the balance sheet, Bitcoins. Corporate integration. Just holding Bitcoin in a corporate treasury is step 1. The real game changer is when companies start weaving Bitcoin into their actual operations. This is where network effects kick in and make Bitcoin indispensable. We're already seeing this happen. Take Trump Media and Technology Group, TMTG. The company isn't just holding Bitcoin, it's building a business around it. After announcing a plan to build a Bitcoin treasury, TMTG acquired over 19,000 BTC. But it didn't stop there. TMTG also filed to launch its own crypto ETFs, shifting from just being a holder to a provider of financial products built on Bitcoin. This kind of operational adoption creates a powerful cycle. When a company like TMTG integrates Bitcoin, it introduces the asset to its entire user base. When it launches financial products, it creates new ways to invest, which drives even more demand. And it's bigger than just one company. A whole new category of company is emerging, digital asset treasuries, or DATs. These are operating businesses that use their corporate structure to acquire and manage digital assets, often with financing strategies an ETF can't use. A few years ago, it was just MicroStrategy. Today, over 100 public companies have adopted similar strategies, each playing a role in soaking up the available Bitcoin supply. As more companies use Bitcoin for payments, for settlement, or to build new services, it becomes deeply embedded in the economy. It becomes essential infrastructure. This ensures that corporate demand isn't just a passing fad, it's a structural shift. Companies will need to hold Bitcoin not just as a store of value, but as working capital, creating a permanent layer of demand for years to come. Section 5. The supply shock climax, the halving and the squeeze. So we have the demand side of the equation, a flood of corporate and institutional money rushing into Bitcoin. But when you mix that with Bitcoin's unique and unchangeable supply schedule, things get really explosive. Bitcoin's supply is controlled by one brilliant mechanism, the halving. Roughly every 4 years, the reward for mining new Bitcoin gets cut in half. This process is hard-coded and ensures Bitcoin becomes more and more scarce until the last coin is mined around the year 2140. The next halving is expected around 2028. Just as this corporate and institutional demand is set to hit its stride, the flow of new Bitcoin entering the market will be slashed in half again. Historically, the period after a halving has always kicked off Bitcoin's most dramatic bull runs. But this time is different. It's potentially far more explosive. In past cycles, the buyers were mostly retail investors. Today, the buyers are corporations and massive ETFs that are systematically taking a huge chunk of the existing supply off the market for good. Public companies alone now hold nearly 5% of the total 21 million Bitcoin that will ever exist, and that figure is climbing. Think about what this means. You have a massive, price-insensitive wall of demand from corporate treasuries and ETFs buying for the long term. This is draining the liquid supply of Bitcoin available on exchanges. At the same time, the creation of new supply is about to get cut dramatically. It's the perfect storm for a parabolic price run. It's a classic supply and demand squeeze, but on a global, multi-trillion-dollar scale. The amount of Bitcoin available to buy is shrinking at the exact moment the biggest pools of capital in the world are deciding they need to own it. There simply won't be enough Bitcoin to go around, forcing anyone who wants to buy to pay a much, much higher price. Section 6. The path to $3 million. So how do we get from here to a wild number like $3 million? It's not one giant leap, but a series of logical steps fueled by the forces we've been talking about. First, corporate treasuries set the foundation. As more companies follow the Saylor playbook, a huge chunk of Bitcoin's liquid supply gets locked away, creating a solid price floor. Second, the ETFs act as a massive accelerator. The ease and regulated nature of ETFs are opening the door for trillions of dollars from pension funds and institutional portfolios. As even a tiny fraction of that capital, say 1-5%, moves into Bitcoin, it could trigger a demand shock unlike anything the market has ever seen. Third, the 2028 halving acts as the trigger. The pre-programmed supply cut collides with peak institutional demand, creating a violent supply squeeze. The daily demand from ETFs and corporations could start to dwarf the number of new coins being mined, forcing buyers into a bidding war for whatever is left on the open market. This is where some wild, but data-driven, price predictions start to sound more plausible. Kathy Wood of ARK Invest has models that predict a Bitcoin price of up to $2.4 million by 2030, based almost entirely on this wave of institutional adoption. The $3 million figure represents the ultimate perfect storm scenario. It imagines a future where Bitcoin isn't just an alternative asset but a foundational piece of the global financial system. It assumes corporations don't just stop at a small allocation but continue to flee their devaluing cash reserves. It assumes that nation-states, watching the corporate world adopt a non-sovereign store of value, decide they need to do the same. It's the logical, if extreme, endpoint of an epic supply crisis. Section 7. Addressing the skepticism. Of course, it's fair to be skeptical. A multimillion-dollar Bitcoin has been called crazy for years. So let's tackle the biggest objections. First, there's volatility. Critics love to point out that Bitcoin's price swings wildly. But for these long-term corporate holders, that's almost a feature, not a bug. They aren't day trading. They're hedging against the slow, guaranteed destruction of their cash. Given the choice between a volatile asset that trends up and a stable asset guaranteed to lose value, the decision is surprisingly rational. Second, regulatory risk. What if governments change their minds? While that risk never goes to zero, we may be past the point of no return. With giants like BlackRock running Bitcoin ETFs and public companies holding billions, an outright ban in a major economy seems almost unthinkable. It would be like trying to ban the internet in 2010. The economic and political fallout would be immense. The debate is shifting from if Bitcoin should be regulated to how. Finally, though it has no intrinsic value argument. This completely misses the point. Bitcoin's value comes from its unique properties: absolute scarcity, decentralization, and censorship resistance. In a world of infinite money printing, those properties are everything. A recent S&P report gave Strategy Incorporated's debt a junk rating, noting the risk of being so tied to Bitcoin, but in the same breath, it acknowledged the company's incredibly strong access to capital markets. That paradox says it all. While old-school finance struggles to value this new asset, the market is rewarding the strategy. We are witnessing a massive wealth transfer happening in plain sight. For the first time, we have an asset with a perfectly fixed supply running headlong into a tidal wave of demand from the most powerful economic players on the planet. The question is no longer if corporations will adopt Bitcoin, but how fast. It started with pioneers like Michael Saylor. Then institutions like BlackRock threw the doors wide open. And all of this is unfolding as we head toward another pre-programmed supply shock in 2028. The silent accumulation is happening now. Every day, more Bitcoin is pulled off the market and locked into corporate vaults and ETF wallets, likely never to be traded for cheap fiat again. This is the supply crisis in motion. The road to a multi-million-dollar Bitcoin isn't a fantasy, it's a story of market mechanics. It's what happens when an unstoppable force of demand meets an immovable object of supply. If you found this breakdown valuable, do me a favor and hit that subscribe button. And I want to know what you think in the comments. What's your Bitcoin price target, and what's the #1 catalyst you're watching? Thanks for watching.